thought there was a big need for commercial real estate investors, people who are in the space, people who are looking to get in the space, come and meet, network, and feature good speakers like Beau, where they can deep insights to different aspects of the commercial real estate space. So, really happy you guys are here. I'm Brian Wagers of Elevate Commercial Investment Group. I'm here local. I live in Rogers. My two partners live in Dallas. So I buy multifamily properties across the country, landlord, business friendly areas. I love Northwest Arkansas. I didn't buy every deal here if it made sense, but unfortunately it doesn't. So, we buy deals in South Dakota, Dallas, Houston, Oklahoma, all across the country. We help investors invest with us passively while we manage and operate. We have about 5,000 doors. We actually just closed phase 3 of watercolors in Centerton last week. So that was a 376 unit A-class deal. We're getting ready to launch a new development deal in Bentonville. So super excited to expand the footprint in Northwest Arkansas. And so happy you guys are here to learn and network.
Cool. Awesome. Great introduction. My name is Missy Liu. I'm also one of the co-hosts as well. My company is Life Mission Capital. Similar concept. Will help people passively invest into real estate as well. Mostly multifamily, short-term rentals. We're also looking at ATM funds and different things. Most of our footprint is actually outside of Arkansas, so we're looking to expand more into Arkansas as well. So for today, we'll have an exciting speaker because I know a lot of you are investing in real estate in some shape or form. Our speaker is Beau Fugitt. I said your last name right?
Fugitt.
You get
the pronunciation correct.
Okay. He's a securities and real estate attorney with Premier Law Group. Actually a pretty famous group in the syndication world. He practices mostly real estate syndications and other private placement offerings. He's an active real estate investor and syndicator over the last 13 years as well himself, with experiences mostly in single family, multifamily properties, and also mobile home parks as well. I know some of the folks here invested in those mobile home parks as well. Beau has a passion and expertise in structuring complex transactions and also finding creative solutions to his clients' capital needs while ensuring legal protections and compliance. And for today's presentation, he's going to talk a lot about different things. Would you prefer people holding questions towards the end or just throughout?
No, just send it out, super informal style, just like a number of you seen me present before, so yeah, it's very informal. If you have questions, throw it up. We may have to kind of hurry up to get through things because in the securities world, there's a lot of rabbit holes that we can go down. So
yeah, well, super excited to hear from him because he's going to cover a lot of things, not just from an active but also passive investor perspective. So there's room for everyone to grow and be educated on. So I'll pass it to you, Beau. You can pull up your slides.
Okay, thank you. Well, thank you for the introduction. I appreciate that, and thank you guys for having me. Excited to be here. Like I said, a number of you guys have seen me speak before, probably here or somewhere around here, and forgive me if you see some of the same slides. There probably will be some similar slides. What I am normally talking about is, well, here, I'll pull up my slide. Okay, so this is me. Premier Law Group, that's who I'm with. What we do mostly is we are a very niche law firm where our headquarters is in Orange County, California, but we have attorneys from Massachusetts all the way to Orange County. And we mostly represent real estate syndicators, right? So people that go out and raise money from equity partners, passive investors to do larger commercial real estate transactions. That is our bread and butter. We do other kind of ancillary transactions along with that, but that is what our firm does. Mauricio Raul is our founding partner. He's all over YouTube, Bigger Pockets and that type of thing. So if you start going down, the legal real estate syndication world on the internet, you're probably going to run into him at some point. He does a lot of that stuff. So anyways, that's Premier. That's what we do. Most of our clients are syndicators, right? They're people that are out there raising money. And what I'm going to talk to you guys about today mostly is from the passive investor side, right? What are the things that passive investors should be looking at whenever you are going to invest money? There's a lot of bleed over. Probably the first half is applicable to everybody. And then the second half, I really try to talk about, what passive investors need to be looking at which I think is also very beneficial for sponsors, right? Syndicators to know about as well, because if your LPs, your passive investors think it's important, you should probably think it's important too. So anyways, we'll get into all that. Actually, the best way to do this probably. Can you guys see if I stand right here? Okay, there's my contact information. I've got some business cards too, but if you want to take a picture or whatever, that's my email, my phone number. Says up here, the real estate investor's attorney, right? I consider myself an investor first. So I bought my first rental property in 2009, right out of high school. I joined the Marines and went and did that, and then came back, did 4 years, and was like, I've had enough of this. Came back and bought a duplex in Fayetteville and started college and did the whole house hack. If you guys are familiar with that concept, lived there, had roommates, partied way too much through college, but it was great, and realized like, hey, this is, yeah, it's pretty great. I didn't know what house hacking was then, but I realized that, hey, I bought this and now these other people are paying my rent, and it was great, right? And so that's how I got into real estate investing. It's grown since then. My wife and I, Lindsay, we invest really all over the state. We've invested some in Texas as well, but we're mostly in Central Arkansas, actually. And so anyways, after got out of the Marine Corps, did undergrad, did law school, and became actually a JAG. Went back in the military as a JAG attorney. That's what I was doing full time. And the whole time, Lindsay and I were investing in real estate. That was our passion. That's what we did. And real estate got to the point where I didn't have to stay in the military, keep moving our family around. We said, let's go home. Let's get out of this. And that's when I said, all right, well, if I'm going to keep practicing law, I'm going to do what I want to do. I'm going to do real estate law. And that's how I got into real estate and syndicating and all that. So that's where I'm at. So anyways, I'm an investor first. I consider myself a real estate investor that happens to be an attorney, not an attorney that also dabbles in real estate. So anyways, that's me. And I've kind of tried to brand myself as the real estate investor's attorney, right? Like, if as a real estate investor, those are the people that I like to interact with. Those are the people that, you know, that's my people. And so I just want to be that voice. If they need legal help, I want to be able to help them. And if I'm not the right person, I mean, I can usually point them to the right person at least. So keep going. Okay, so today we're going to talk about real estate syndication. I've thrown that word out a number of times. Most of you some of you probably know what that is, but if you don't, it's another OPM tool. What I mean by OPM is other people's money, right? That's how you make money real estate investing, right? Whether it's the bank's money or wherever the case is, the game is use other people's money to buy real estate that you own. That's the name of the game. That's not the only way to do it, but right, that's the game. So it's just another OPM tool. And it's specifically, we're talking about passive investors. That's the easiest way to remember it, is we're talking about partnering with people, but they're not involved in the business at all, right? They are passive. All they're doing is they're giving you the money and they're saying, hey, you know, do your thing. So we're going to talk about, you know, this meetup is all about commercial real estate, more high level stuff, but I try to keep things simple and basic. So the first real estate syndication that I did was we were buying single family properties in Central Arkansas and elsewhere, and we ran out of money, right? Because you're putting 20% down on these properties, pretty quickly you just run out of money. And we were finding deals, but we didn't have any money. So my in-laws saw what Lindsay and I were doing with real estate investing, and my father-in-law's a dentist. He's retired. You know, they're the baby boomer generation. They had extra capital, but they didn't want to fix toilets. They didn't want to go find properties. They didn't want to, you know, cold call sellers and have people, you know, cut you out because you give them a ridiculously low offer. But they saw what we were doing, and they said, hey, you know, if you guys ever find a property that's good, we would love to invest. So we found one. We didn't have any money, and we called them up and said, hey, would you like to do this? And they said, yeah, but we don't, right? We don't want to manage it. We don't want to do anything, right? So boom, that was a syndication because we had passive investors. It didn't matter that we only had a couple people, or really just two people, right? And it didn't matter that they were family. That was a syndication. And really what we were doing at that point, we were selling securities. And they mentioned that I'm a securities attorney, and that's really what we're going to talk about in syndication, right? It's securities. We're talking about the Securities and Exchange Commission, the SEC, right? So when you get into this passive investor world, then the SEC gets involved. We'll talk a little bit more about that. Okay, securities, syndication, joint ventures, and partnerships, right? So you may be saying, well, Beau, I don't understand, if I just bring in partners, right? You tell me that that's a security, that's a syndication, what are you talking about, right? So there's a distinction, right, between a joint venture, or some people call it a JV, or a partnership, and issuing and selling securities. And that's when you bring passive investors. So just throw out some scenarios, okay? So Brian and I, right, we know each other, we're both in real estate, and I find a good deal, but hey, maybe I don't have all the money, or I don't have all the time, or whatever it is. So I call Brian, I'm like, hey Brian, I got this good deal. Do you want to partner with me? And you can be in charge of the accounting and the renovations, and I'll do the property management and whatever the case is, right? We both have an active role in that business. That is a joint venture, that is a partnership. Since we are both actively involved in the business, that is a partnership, that is a joint venture. There's no securities, and that's great because now the SEC doesn't get involved. We don't have to worry about SEC regulations and all that. It changes whenever Brian says, yeah, I'm in, but I don't want to do anything. I'll give you my money, but I don't want to be involved. Now it's a security. Because he's strictly passive and we're not both in the business, it's a security. And so then I have to say, okay, well now I got to worry about all these SEC regulations. I have to worry about all the securities regulations. Is the deal worth it at this point? So that's the difference between a syndication, a security, and a joint venture or partnership. This is the definition of a syndicate, right? The term syndication is just, it's kind of the buzzword in the real estate community. When people say syndication, what they're talking about is issuing securities for real estate investments, but syndication is just kind of the buzzword.
So is there any, is it essentially the same process as what people do when they do a startup business?
Perfect.
It's the exact, it's the same thing, right?
Yes, that's exactly right. Buying an apartment complex, right? You're starting a company, you're starting a business, and that business is, we're going to operate this multifamily property, we're going to operate this apartment. Our firm, right, we do deals, oil wells, right? People want to raise money to go do oil wells. We've done like Bitcoin fund operations. We've helped other startups. So yes, it's the same exact process. And that's why it makes more sense if you think about it that way, right? Because the SEC, what's the SEC? That's the stock market, right? All this and that. That's what you're doing when you syndicate real estate. You're essentially issuing stock in a company. What's the business of that company? It's real estate. And so it's the exact same process. Yeah.
So you set up the business, and then the shares of the business.
That's right.
For everything. Okay.
That's right. That's it. Exactly right. Okay. Overview and history of securities laws and regulations. I talk to people in the real estate space, and we'll start talking about all these regulations. And sometimes people look at me like, this doesn't make any sense. Why are there all these additional rules if I have passive investors? And it all starts from the Great Depression, right? So the first federal securities laws, and there were no state securities laws either before then, the Securities Act of 1933. What happened right before 1933? The stock market crashed in 1929. And that's because there was no regulation in the stock market up until this point, right? It was free for all, right? Hey, you can buy a share of the Brooklyn Bridge, right? There was all these scam artists out there. And that was part of what led to the stock market crash. And so the federal government said, hey, we've got to do something. We've got to regulate all these passive investments because it's detrimental to our economy, right? It crushed the economy. So they said, we've got to step in and we've got to put some consumer protections out there, some investor protections out there. And that is where all of this stems from, right? So you have the Securities Act of 1933, the Securities Exchange Act of 1934, which regulates, right, the SEC, all the stock markets, everything like that. Investment Company Act of 1940, Investment Advisors Act of 1940. I could keep going, there's more. But these are the big ones that I run into on a daily basis doing real estate syndications. These are the big federal laws. Now, in addition to these federal laws, every state has their own security laws and regulations as well. So it has become a very robust area of the law, but that's why we have it, right? To answer the question, why are there all these extra rules for passive investors? That's why. And I think it's just good to kind of lead with that to give you the good a good frame of reference as to why we're going to talk about all this other stuff. This slide came through. I apologize. It should be bigger. This is the statutory definition of a security. And if you look at this definition, so this is right out of the Securities Act in 1933. And if you look at this definition, the word security is in the definition 5 times. So it's very difficult. You read this, it's like, what am I? That doesn't make sense. And I know there's some other lawyers in the room, and unfortunately, that's can be fairly common whenever you're looking at legal definitions. But yeah, this is the definition of security, and I'm going to touch on this part right here because you say says the term security means any note, and it has all this other stuff, right? But we're going to come back to that. The any note, just remember that, okay? Any note. But it goes through, anyways, it's a super complex definition, and it was fairly unclear. People didn't know what securities were, and that's why the Supreme Court had to step in and say, look, we're going to make this a lot simpler for you guys. And that's, we have SEC v. Howie. It was in the 1940s, and it was actually a real estate deal. There was this guy named Howie down in Florida who was selling, he had a hotel, and then he had orange groves. And his thing was he would have people come to his hotel, and then part of the experience was he would give you a tour of the orange grove, and he would say, for a limited amount of money, you can be an investor in this orange grove, right? You don't have to do anything, but you can be an investor. We make the orange juice here, right? And you can just be involved. Well, the deal went south, right? There was a drought. I can't remember exactly what happened. Some investors got upset. They sued him. It got all the way to the Supreme Court. The Supreme Court said, yes, you were selling unregistered securities. You were violating securities laws by doing this. And so now you're in trouble, right? And so they gave us this test in SEC v. Howie. And these are the kind of the 4 or the 5 elements of the test, right? And it is a person, 2 or more people, investing money or value. Some circuits have gone on to say that it can include not just money, but some type of value or exchange in a common enterprise with the expectation of profits from the efforts of others, right? And I have an asterisk right there because that's what makes it passive, from the efforts of others. Right here, people investing money in a common enterprise expecting profits, that can be a joint venture, right? It's when you get to this last element, from the efforts of others, that passive investor element, that's what makes it a security. And that's when the SEC is going to get involved. That's when you have to abide by all these other regulations. Yeah, so thank you, Supreme Court, for that test. But we're not done. We have the USB Reeves test too. Now remember, I made a big deal of that any note. The security means any note. Well, the Howie test kind of gave us the test for when is an equity deal a security, right? What Howie was doing, he was going out and he was getting investors to buy into the orange grove, right? They're essentially in the same company. What I'm seeing as interest rates are getting higher and higher, we have a lot of clients coming to us and they're saying, all right, we want to pivot. We're not going to do securities. We're not going to do syndications. Instead, we are going to raise debt from our investors. So we're going to go to all of our investors, and they're not going to own the real estate with us. We're going to give them a promissory note, and we're going to borrow money from them. Well, that's exactly what happened in USB Reeves, and they said, see in this definition, it says any note. What they're talking about is a promissory note, any note. And it really comes down to the crux of it all, when we talk about this family resemblance, is are you getting investors to invest into a deal? Whether you structure it as a note or an equity, that's really not the crux of the issue. Is are you going out there and are you soliciting investments from people? And if you're doing that, then it's likely a security. Now, there are a lot of situations when we know for sure that a loan is not a security, right? There's other regulations, right? So, for example, a bank. If you go get a loan from a bank, there's no securities involved because the justification for that is that banks have their own plethora of laws and rules and regulations that you have to abide by. And the federal government essentially said that people that get loans from the banks, or the bank is actually the one issuing the loan, the bank's protected. The bank has its own rules. There's enough protections in place. We don't have to worry about that. Loans involved in consumer financing, right? So when you get your new iPhone, right, and you're on a payment plan, That's not considered a security. Note secured by a mortgage on a home, seller financing, right? I know there's some real estate agents in the room. Whenever you go out and you tell the seller, hey, I want seller financing, and the seller says, okay, that's fine, but I'm going to take a mortgage on your property. That's not considered a security. And then short-term notes, something less than 9 months typically, secured by liens on small business or some of its assets. We know that these things are not going to be securities. Now, the more you get into the securities world, you start to see that a lot of the terms and the rules and the regulations are extremely nebulous. It's like we just operate in this gray zone all the time. And so you'll have people come to me, well, is this, and sometimes the best advice that I can give them is it's a probably, it's a probably this. And so why don't we take these steps to make sure that you're covered? But that's just the nature of securities regulation in general. So that's what we're talking about. That's what we're talking about, securities. Does anyone have any questions? Because I know that's a lot.
I have a question. So in terms of making something a joint venture rather than a syndication, how much work would be required from the person partnering on the deal?
Great question. And that's one of those nebulous terms, right? So substantial duties or substantial efforts. Tell me what that means, right?
Yeah.
So it has to be substantial. When you start to get, more than 6, 7 people in a real estate deal, that's when I start asking people, all right, what's everybody doing? Okay. Because there's only so much work with a rental property, right?
Yeah.
So what is everybody doing? Now, if we're talking about a startup company, it's a tech venture startup, hey, maybe 7 people, yeah, absolutely. But in real estate deals, you really gotta start digging in, okay, what's everybody doing here?
So to get like really practical with it, say you had somebody who was paying the down payment so you could buy a property and do a fix and flip. What would that person have to do to make it a joint venture versus a syndication? So
is what I say is the more duties you can give someone, the better.
Yeah.
Right. And if you can make them, if they know accounting, have them do your books. If they are experienced at all in developments or construction, right, have them be involved in the renovation process. If they know anything about property management, have them be involved in that, right? The more duties you can give them, the better. And that's I know it's not a good answer.
Vague, yeah.
But that's the answer that we have to give.
Gotcha.
The more duties you can have, because ultimately what this is going to come down to is if you're audited by the regulators, whether it's the SEC or state regulators, and they say, hey, you're issuing an unregistered security, then you've got to be able to go to them and say, no, I wasn't. And here's why, right? It's not from the efforts of others. That last prong, that test, right, that we talked about. Look at all these efforts that's this person doing, right? They're coming to the board meetings, they're making these decisions. Here's all these emails where they're telling us, no, I want paint it gray, not green. The more that you can show, the better. The benefit to this is that securities regulators, for the most part, are not diving into real estate deals, right? They're not diving into the Airbnb that I bought with my dentist father-in-law, right? For the most part, they're looking at the Sam Bankman-Frieds of the world, right? They're looking at these startup. There's only so much bandwidth, and for the most part, they're not just out there. It's not like the IRS, and you're just going to get picked and audited, right? Because what's going to happen is one of your investors, the deal's going to go bad, and one of your investors is going to get upset, and they're going to want to sue you for whatever reason. And then their plaintiff's attorney is going to say, hey, based on what you're telling me, I think they were selling unregistered securities, so we're going to get them for that too. We're going to sue them for that. That is, when I see people get in trouble, 90% of the time, 95% of the time, that's a scenario that comes up.
Do you think that the rise of the syndicators over the last year, that and the example of like the Houston deal that went bad after 1 year, is this gonna become a targeted thing and more are gonna see go against, because they're all, capital calls are coming from people, different things, and people are like, whoa.
So I'm notoriously horrible at predicting the future, but but I would not be surprised. So the Wall Street Journal, I saw 3 pieces that the Wall Street Journal did about, they did like 2 on him, and then they just did a hit piece on real estate syndication in general. Talking about you have, it's people like Mauricio, right? My boss, if you get on YouTube, there's this whole like niche world of real estate syndication, and it's become popular over the years. In the last 10 years, real estate has done really well. And with inflation, people's net worth, we're going to get into it. You have a lot more accredited investors now than you did in 1982 when the rule for accredited investors was created. And so this business model of real estate syndication has become much more viable. With that, it also, the exact same reason that we have the regulations in the first place, there's a type of person like this guy down in Houston, these fraudsters, that they say, hey, ooh, other people's money, right? It's a way for me to get other people's money. And unfortunately, there are people in the space that are going to make it harder for the rest of us. So there we go. Okay, so you're going through a deal. It turns out, yes, what I have is a security, right? The way that I'm structuring this, it is security. What are my options? Okay, you got three options. Really, you got two options at that point. One, you can register your security, which is essentially means going public, like being a public traded company. You can find an exemption to registration, or it's illegal. Very good. So that's why I say you really only have two options. Okay. Really, I said you always have three options. You can the amount of non-compliance in the real estate syndication space, the amount of securities that are sold, not in compliance with the rules and regulations, I think is rampant. I think a lot of people just don't know, right? They just don't know. And they go to their father-in-law, who's the dentist, and they just take the money. And there's I think a lot of times it's not even a problem, right? It's my seatbelt analogy, right? We all drove here, presumably, all of us rode in a vehicle here. I'm guessing that probably all of us wore our seatbelts. And yet none of us got in a car wreck. We're all fine. Probably all of us would have been fine had we not worn our seatbelts. And so now we're talking about what's the actual risk. Well, okay, maybe you can get away with not wearing your seatbelt, maybe you can get away with not registering securities, but eventually you keep driving enough, you don't want to wear your seatbelt. You start doing big enough deals, you're gonna want to make sure you have your seatbelt on. So I can't remember what got me down there, but those are your options. You have the option not to wear your seatbelt, right? But it's not smart, especially when you have other people in the car with you. You tell them, don't worry about it. We don't need seatbelts. And it's kind of a good segue into what we're talking about, right? As a passive investor, what should you be doing? And so I would say, if you're going to get in the car with somebody and they're like, yeah, we're going on a road trip, but this car doesn't have any seatbelts, don't worry about it. You would say, no, not going to do that, right? And so that's kind of the same thing here, right? What should you look for whenever you're the passenger in the vehicle? Seatbelts would be number one. And we're going to talk about different seatbelts. So real quick, the other thing too, those are your options. You have to register it, you have to find an exemption, which that's what we do in real estate syndication. We find an exemption, and we're going to talk about those. Also, the sponsor, the person issuing the securities, you have a fiduciary duty to your investors, right? The same as lawyers have fiduciary duties, trustees have fiduciary duties. Fiduciary duty means you have a relationship to somebody else, and you have to put that person's interest above your own. And this is the fiduciary that you have. It's care, loyalty, and disclosure. All right, so what does that mean? It means I have to care for their investment. I have to care for their money. Going back to this guy in Houston, right? I think his properties were just awful, right? They weren't up to code. All the pools were full of like sludge, right? He was totally neglecting those properties. He was not caring for the asset. He was breached his fiduciary because he was not caring for his investors, right? That's their asset. It's not just his, that was theirs. And he wasn't caring for it, right? So he breached his fiduciary there. The other thing is loyalty. And this means that you cannot go behind your investors' back and benefit in some way that is at their detriment, right? You have to be loyal to them. We always put disclaimers in all the paperwork that we put together for real estate syndicators that, hey, I may technically compete with you, right? Because you get to the third thing is disclosure. We can do a lot of things as long as we disclose it. You can say, hey, I may go buy another apartment building across town that you don't own. So technically, I'm going to be in competition with you, right? And so that theoretically could breach your duty of loyalty, but we disclose it. And if you disclose it, then it's okay. And that's, I tell syndicators all the time, you can probably do it. Whatever you want to do, you can probably do it, but you just have to disclose it. I'll talk to clients all the time and they'll say, okay, this is what we're doing, but hey, so for example, right? I had this client 6 months ago or so. He owned the piece of ground that they were going to develop a property on. And so he was going to raise money in this LLC, the syndication LLC, to then purchase the property, and then they were going to develop it, which is totally fine. But he didn't want to tell his investors that he owned the property. No, sir, you cannot do that, right? Disclosure, you have to tell people, if you're making money as the sponsor, you got to tell them. And if at any point in time, you're saying, I don't want my investors to know this, ding, 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 you're breaching your fiduciary. You need to tell them, or you need to not do that thing. All right, so we had to advise him, no, you have to tell them, here's why. So that's your fiduciary. All right, so now we're going to go back to, right, so we talked about, you got to register, you got to find an exemption or it's illegal. So we're not going public in order to buy an apartment building. So we got to talk about the exemptions. So that's what we're going to talk about now, is the most common exemptions that we find under the federal securities laws to do real estate syndications. But first, before we start talking about that, we're going to talk about accredited investors and what is an accredited investor. And the reason we're going to talk about this is because different exemptions either apply to accredited investors or they don't. So what is an accredited investor? This is not the full list of what an accredited investor is, right? But this is the main thing. From passive investors, you're the dentist out there, whatever, you're the guy with money, but you don't want to go find real estate deals. We're just going to talk mostly about people. So it's someone with $1 million net worth, excluding their primary residence. So if you meet that, you're an accredited investor. Or you make $200,000 a year for the past 2 years with the expectation to do the same in this year. Or if you're going to do it jointly with you and your spouse, it's $300,000. $300,000 for the last 2 years with the expectation to do the same this year. The other way you can be an accredited investor if you don't meet those kind of these income and net worth standards is if you have the right license and if you're a registered investment advisor. So Series 7, Series 65, Series 82. If you take those tests, you pass those tests, and you're licensed, and actually, it's not just enough to pass the test. You actually have to be licensed and operating under the umbrella of a brokerage. Then you're also an accredited investor. Okay, so why is this important, right? Again, let's go back to the reason that we have securities regulations in the first place. It's to protect the investor. So is what the government said. They said essentially, hey, if you're a millionaire, you're all right. Either you know enough about money that you know what you're doing, or hey, you're a millionaire, so if you do a bad deal, whatever. We're not worried about you, right? We're worried about mom and pop. Same thing. If you make $200,000 a year, all right, we're not worried about you rich people. Essentially, that's what the law's getting at, right? But then you had all these, people that were fresh out of college, whatever. But hey, I just got my MBA in finance, and you're telling me that you got to protect me? Like, I know business, right? And so they realized, like, yeah, okay, so maybe there are some situations where you don't have to be rich if you have demonstrated that you have this knowledge base, then we'll call you an accredited investor there as well. Now, fun fact, this rule was made in 1982. So someone who had $1 million net worth, someone who had $1 million net worth in 1982 is very different. Someone who was making $200,000 a year in 1982, very different than making $200,000 today. Which is also, I think, a big reason why the real estate syndication business model has become more and more viable. It's because you got a lot more people. There's a lot more accredited investors now than there were in 1982. But back when this was written, very few people were doing this stuff because you couldn't raise money from people. So, anyways.
So this is an or, not an and.
This is or, yeah. This is all ors. And then there's more to this too, right? Entities, right, with over $5 million in assets that were not created for the specific purpose of investing in the deal, right? Trust. There's more things than this, but if we're talking about the majority of real estate syndication deals, which is kind of what the focus of this presentation is about, that's what accredited investors are. Okay, so now we're going to talk about exclusions, or exemptions, I should say. So the most common is Regulation D, Securities Exchange Commission Regulation D, rules 506B and 506C. These are the most common in the real estate syndication. Brian, would you agree with that?
That's right,
Yeah, there's a few more out there like crowdfunding. We'll talk about that. That's more and more popular, but these are the most common. Okay, so what is it, right? So if you essentially, what these exemptions say is that, hey, if you follow all these rules, we're not going to make you register as a security. And you also don't have to worry about all the state laws, all the state securities laws, because if you follow these rules and if you do all these things, these are going to preempt state law. So you don't have to worry about all the state regulations. So most of the time, that's what we're doing, right? We tell our clients like, hey, don't worry. We don't have to worry about what state you're in or what state your investors are in, because we're just going to follow these rules and we're going to preempt all the state law. You don't have to worry about that. So with a 506B and with a 506C, unlimited amount of money. You can literally raise as much money as you want. There's no rules to how much money you can raise. But now we get into this accredited investor stuff, right? With a 506B, you can have up to 35 non-accredited investors. So people that don't meet that definition that we were talking about. You can have 35 of them. Once you get more than 35, can't do it anymore. You can have an unlimited amount of accredited investors in 506B, but you're capped at 35 non-accredited investors. The caveat to that, those non-accredited investors still have to be sophisticated. What is sophisticated? It means that they have the experience, education, and knowledge to understand and appreciate the risk of the investment and the merits, right? So we have some real estate agents in here. Maybe you're not making 200 grand a year. Maybe you don't have a net worth of $1 million, but you know real estate and you know good real estate deals. So if I'm going out there raising money, hey, maybe you're not accredited, but if I know you, I know that you understand the risk and the merits associated with real estate investing. And so you would be sophisticated. Oh, with a 506B, you can have up to 35 non-accredited investors, but there's no advertising and no general solicitation. A 506B is like Fight Club, okay? You can't talk about it. You can't get on social media and you can't blast it and talk to people about it. Because when you're doing that, now you're advertising and you're soliciting. And you can't do that with 506B.
What's the line of what's advertising and what's not?
It's so, well, so let me, I hopefully
Because you still have to
explain.
communicate the deal to
Right,
the person.
Right, so you can still communicate, but in general, you need a pre-existing substantive relationship with that person.
Okay.
Okay, so I just can't go out there and start soliciting people, and that's why you can't advertise, right? But if we know each other, right? We've met each other here, we've gotten to know each other. I know, even though you're not accredited, I know you're sophisticated. I know you understand the risk and the merits of the deal. I can come to you
Okay.
and I can say, but you need that, right?
Okay.
So is what we'll do a lot of times is we'll actually do two of these offerings. We'll do a 506B first. So if somebody wants to raise $5 million, let's say for a deal, we'll do the 506B first and let them go out and talk to all their friends from high school or whatever and say, hey, you know, we're doing this, here's the deal. We can't talk about it. We can't put it on social media. We can't do any of that, but we'll raise the money that way. And then it's like, hey, I'm still $1 million short. Then we'll say, okay, we'll close the 506B. And now you can do the 506C. Now you can get on Instagram, you can get on Facebook, you can get on YouTube, you can do whatever you want. You can take an ad out in the newspaper. You can advertise this, but when you start advertising, you can only take from accredited investors. So we'll do that a lot.
So those
But-
can be, sorry, those can be pulled together though.
This is for the same project, you can use
It's
both.
the same project, but they're different securities offerings, right? So I'm selling these securities and you got to do the B first. Because if you do the C first, now you advertise. And now you've blown the whole exemption. So you got to do the B first. And it's also too, it's like one post on social media kills it. You know, if you mess up one time and if you're working with a team of people, you better make sure that everybody, it's like, hey, we're doing a B, guys. This is the Fight Club deal. Like, do not talk to people about this.
Does it have to be a specific offering to make it, like if you just, hey, in general to friends, anybody interested in investing, does that then qualify for that if it's no deal specific, or does that matter?
So the way to get around that, if you start talking about a specific deal, you're gonna get crushed.
Yeah.
But what I can do right now, right? So I don't have a pre-existing substantive relationship with all of this. We've chit-chatted some, but I don't know you. I don't know if you understand the risks and the merits. But I can say, hey, just show of hands. this is what I do. I invest in real estate. I do these limited partner deals. Would anyone be interested in something like that? Okay, you put a grant, then so I say, okay, great. Well, you got my email. Give me a call. Let's talk. And now I develop that pre-existing substantive relationship with that person. Once I have that relationship established, then I say, okay, I got this deal I'm going to tell you about, right? And if you go onto YouTube, this is one of the rabbit holes we could go down, but if you go onto YouTube and search for Mauricio Raul with Premier Law Group, he has a YouTube channel, and he's actually talked about there's 8 steps that we recommend to establish a pre-existing substantive relationship with someone. So it's like, how do I do this if that's what I'm trying to do? And so, we'll say things like have emails, right? Because we're attorneys. At the end of the day, we're saying, okay, if the SEC is coming after you, you're gonna be like, no, look, I've showed you this email. We went and had coffee on this date. We had phone calls on this date. We talked about these things, right? I knew this person, and I knew them well enough to know that they were a sophisticated investor. That's what we're looking at.
Did there used to be a time frame with that also?
It's not set in stone. The longer the time frame, the better. But that's one of those nebulous things, right? Because you and I can meet on an airplane if we're flying to wherever, right? We're flying to Australia and we're on a 6-hour airplane ride, and we could start talking and we could get to know each other fairly well if we know each other, that long. And I find out that you are a real estate genius, then I could probably say, okay, well, that might be good enough. The longer the better, obviously, and it's one of those things. I would advise you to wait and give it time and have multiple touch points. That way, if someone ever did come that challenged you, you can say, look, we had a 6-hour plane ride, we had coffee, we had a Zoom meeting, we had right? I talked to him for 3 months before I ever talked to him about this 506B offering. The more the better. Both of these preempt state law, and then check the box verification is okay. So with a 506B, what I mean by that is if you have 506C, there's an extra step that there has to be a third-party accreditation that they are an accredited investor. They have to get a letter from their CPA or their tax attorney or their third-party companies that are out there that will actually look at their tax returns for the last 2 years and say, yep, they made $200,000 for the last 2 years and they're probably going to do the same this year. When you do the 506B, you got to take an extra step of actually verifying that they're accredited. With 506B, you don't. So these are the 2 most common by far. Any questions about that? Okay. These other, I'm not going to touch on these as much because I don't want to run out of time. We still have a lot more to talk about, but you also have Regulation A+ and Regulation CF, which is crowdfunding. You guys are familiar with like Fundrise or a number of these other platforms, right? That's what crowdfunding is. With both of these, the SEC is going to be more involved. They're actually going to look at your deal before you can go out and raise money. So with Reg A, number one, it's a lot more expensive. We're working on some Reg A's right now, and you're looking at least 6 months before you can actually start raising money because you have to take the deal to the SEC, and the SEC's got to look at everything and be like, okay, yeah, this looks good, and they'll come back and say, no, this don't like this, whatever the case is. And so there's all this back and forth with the SEC. But the good thing about this is you can advertise and you can take non-accredited investors. Why is that? Well, it's because the SEC's already vetted it. That's the kind of the justification behind it all. Same thing with Regulation CF. There is back and forth with the SEC, but there's rules about you're limited, right, as to how much money you can take, and your investors are limited as to how much they can invest. They can only put a certain amount of their actual net worth into the deal. So the rules they're kind of capped at how much they can put in. People certainly do this for real estate deals. Not as common, but there certainly is. And then this is probably my favorite one is the intrastate exemption, right? So take you guys to law school real quick, right? Anybody know the 10th Amendment? Not you guys, you know the answer. But the 10th Amendment says everything that we didn't list in these first 9, that's the states. The states, we leave that up to the states. That's federalism in our legal structure. The states get to make those rules, right? And then later on, we had a court case that said, but if it deals with interstate commerce, if more than 2 states are involved, then the federal government gets to put their hands on it, right? So I'm more of like a limited government type person, right? I don't like when the federal government tells me what I can and can't do. So that's why I like the interstate exemption. If the deal, let's talk about real estate again, right? Because that's what we're talking about. If the property is in Arkansas and I'm in Arkansas and all my investors are in Arkansas, then the federal government can kick rocks, right? They don't have jurisdiction over what we're doing in this state. So it's not really an exemption. It's just the federal government doesn't have jurisdiction over us. So you still have to comply. Now we're not preempted from state laws, right? We still have to comply with Arkansas's securities regulations. Fortunately, we live in a great state of Arkansas, and our securities rules and regulations are not as burdensome as a lot of other states. So I like this, you know, it's better for smaller deals. If you are gonna go out and do a single family deal from your dentist father-in-law, then hey, the intrastate offering may be a good option for you.
What are the limitations to the exemption, or are there any?
So it's technically not an exemption. There are limitations. It depends on how much money you're raising, how many investors you have, whether or not they're accredited or not. I would say for the most part, you know, if you're going to raise from non-accredited investors, it's probably, even if it's a totally intrastate deal, I'd probably say let's do a 506B and just we'll comply with those rules. But you know, if it's a smaller deal and you're going out and you're talking to your doctor friends or whoever, then we may want to look at the Arkansas rules. Okay, any questions about that? So those are the most common exemptions for real estate syndication. Now we're going to move on to the types of syndications and the most common models that I'll see. And I'll try to go through this quickly because I know we'll run out of time. If I get late on time, just tell me to wrap it up. Give me the book. Okay, so this is like the deal specific model, right? This is where you have your sponsor who goes out and finds the deal. They create an entity, right? They create an LLC. We put together an LLC that we're going to buy the property with, and I bring in my passive investors. In this case, right, I'm going to come to you guys if I'm putting the deal together and say, hey, I'm looking at this property off of Old Wire Road. You know, these are my projections. This is how much money I need to raise. Most real estate syndications kind of fall into this, right? And what I'm pitching you is the actual piece of property, right? I'm showing you the deal that we're gonna do. That's your what we call a deal specific model. The next is the fund model, right? And this is where I come to you and I say, now look, I don't have a property that I'm going to tell you about right now, but trust me, I'm super good at this, right? And just give me your money now. That way, when I find this good deal or these good deals, I'll have the money to do it. And we're going to do this over and over again. And now fewer people do this, but there are people that do this, right? You know, people raise funds all the time, and it doesn't have to be for real estate. People will do it for all sorts of things, right? If Warren Buffett came to you and was like, hey, I don't have the deal right now, but give me your money. Like when I find the deal, I'm going to put your money in it. You'd probably like, yeah, here, you got money. Go ahead. And so what you're selling here, you're selling yourself more, right, than the property itself. You're saying, hey, right, I have experience in this type of thing. Trust me, I'm going to put your money in a good place. There's pros and cons to both, right? The con is this is harder, right? If I came to you guys and was like, hey, give me your money, trust me, it's going to be great. You may be like, I don't know about that. Versus if I was like, hey, here's the deal. I'm getting a great discount. I'm under contract on it, right? It's much easier to sell that if I can actually show you the deal. But the pros to this is sometimes it's hard to raise money, right? Talk to Brian. You get under contract. Now I'm closing in 60 to 90 days. Now I got to go raise all the money before I can close. Well, if I already had the money, it would be a lot easier, right? So there's pros and cons to both.
Is this something like a lot of residential developers will do? Like they pool money and they develop neighborhoods or something?
Yeah, and even that could be a deal. You could call that a deal specific, right?
Yeah. Because
Because it's like, hey, we're gonna. I could show you the master plan, right? I could show you like, hey, here's the plan, right? This is the spec of like the home that we're gonna build. So even that could probably, you could call it a deal specific syndication.
Gotcha.
And then I assume that both fund model or deal specific still falls under the Reg B or C.
Yep.
So you could raise the fund under Reg B.
Exactly. You or A plus CF, right? You still got to find that exemption if we're doing security.
Is this like the Cardone Capital model?
Yeah, so he does, I would say probably, he's doing Reg A's now, I think, last time I looked.
Right.
And yeah, because I don't know, because I'm like in this
I get
space,
a lot of questions.
I get bombarded with like real estate syndicators. I get on like all their emails somehow.
Yeah.
And I'm getting, so I don't like look at all the deals that I see anymore. I don't look at Grant Cardone's deals just because it's like, I'm not gonna invest. You know, like I know I'm not gonna invest, so
Is he in trouble with anything?
he got in
like
trouble with the SEC a while back, and I don't know what came of it. He's still out there issuing securities, so he didn't get in that much trouble,
Yeah.
because that's the one thing. If you get in trouble for violating security laws, one of the penalties is they can bar you from transacting in securities transactions. So he's still out there raising money, so I don't think he got in that much trouble.
So it wasn't publicized what the issue was?
Oh, it was, yeah, he was, I think he was advertising and taking money from non-accredited investors. And so he probably returned all their money, you know, I would need to look into it more.
Yeah.
Yeah, I know the SEC was,
So before he was doing Reg A, maybe he was.
yeah, I think he was either, it was probably just that he was like sloppy, right? It was
Yeah.
probably just that he was sloppy, probably, you know, you gotta do it. So this is what we call a fund to funds model. And this is when I say, hey, I don't have a deal for you, but I'm in this space all the time. I know all the best real estate syndicators. So when they when they have a deal, I'm gonna take your money and we're gonna go be passive investors in that deal. So I'm gonna start a fund, I'm gonna start an LLC or an entity, and I'm gonna raise a bunch of money, and then I'm gonna go find the guys like Brian, right? And I'm gonna go find those guys, and then I'm gonna invest in there. And the benefit of that is, right, like, you know, I mean, Brian, you probably speak to this, but if I have a fund, I've got 5 million liquid capital in my fund, and I go to somebody, maybe I can get some preferential treatment. Maybe they were gonna give a 6% preferred return, but I say, hey, well, if I bring in half the money that you need, right, can I get 7? Right? Sometimes you can negotiate. So if you have those funds, sometimes you can get better deals. The issue with this is what you're doing at this point is you're issuing securities to then go purchase securities, right? Because I'm issuing securities, I'm bringing in passive investors, and then what am I going to do with that money? I'm not going to go buy real estate. I'm going to go buy securities. I'm going to be another passive investor, so it's an extra leg. When you do that, you subject yourself to the Investment Advisors Act of 1940, because now you're an investment advisor, and that's when you're going to have to register, depending on your state, as an investment advisor. And the Investment Companies Act of 1940, you're going to be treated as an investment company. There's certain things you can do, right? Like keep it under 99 investors, and they're all accredited. Then, you know, you can certainly do it. There's just some more hurdles to jump through, and we're not going to go down that full rabbit hole because we can talk about this stuff for hours and hours. But that's the other like common model, and it's gotten more and more common because there are some people out there that are just really good at raising money, right? Maybe they're not so great at going out and finding real estate deals, but they're good at raising money. And so it's like, well, hey, you know, this is my skill set. I'm really good at raising money. I'm not necessarily good at going and finding real estate deals, but I know a lot of other people that are. So it's gotten more popular.
Yeah, and like you said, it's a great model, and also it's a great model for some of the limited partners too, because you can just work with 1 or 2 fund managers that's really good at allocating money versus trying to find like 10 different operators to work with.
Right.
That's the model we'd like to go off of, even when we've done the deal specific funds and also we've done the fund based. But
Yeah.
the funds one has been one of our favorites because of the ease of you know, just park it with 1 or 2 and get
Right.
diversified.
Yeah. And that really goes to it is an investment advisor, right? The same way like you're not gonna go out there and pick all your own stocks. You give it to one person that's in that space constantly, and they're say these are the good stocks, and I'm gonna pick them for you.
So does that manager have to become an RIA?
It depends on the state.
Okay.
It's a state issue. I actually need to look at Arkansas again, and the way that I learned about these rules is I'll have a client come to me and I'll say, what state are you in? And then we'll do a deep dive into that state. And I haven't had anyone in Arkansas want to do this. So that I have to report. So I don't know. I'd have to look into that. And I just don't look into stuff for fun.
Is there a difference between the fund and maybe the operating company, or is this the same thing?
No, that's a great question. And that's another rabbit hole that I could go down. But so okay, so well let's do the fund, right?
Yeah.
Normally is how we'll also structure these is the actual sponsor, the person issuing the securities, we'll have them be the manager of this LLC,
Okay,
but it's not the LLC itself. And the reason that we do that is for asset protection reasons, right? If
so you might have an LLC manager
Of the LLC.
fund.
every time, that's how we'll structure it.
Right.
And that's more for asset protection, and we can talk more about that. I could go into that, but yeah.
That answers the question.
Okay, yep. Okay, so those are like your pretty common models, right? I'd say the deal specific and in that order, right? Of what I see at least in the industry. Asset protection basics, right? And now we're shifting to really talking about if you're a limited partner and you're considering investing in one of these deals, the things you should consider. Okay. Everything, whether you're the GP or the LP, when I say GP and LP, what I'm referring to, that's like the lingo in the space is GP and LP. GP stands for general partner, LP stands for limited partner. LLCs were not created until like the late 70s. Okay, so before that, every deal like this had to be a limited partnership. And you had the general partner, who was the person out there actually operating, and you had the limited partners, they were the people bringing in the money. Most of the time now, 90% of the deals, you're going to have an LLC, so there's not technically a general partner and a limited partner, but that's just a lingo that has developed. What we're talking about, the sponsor and the passive investor. Sponsor is the GP, limited partner, the passive investor, the LP, even though technically I'm not limited partners. But anyways, now asset protection, this is really designed for LPs, your passive investors. I know I'm probably going long, so I don't know, wait a minute.
For, maybe maximum another 2 minutes.
Okay, so asset protection basics, right? Holding company basics, corporate veil, asset protection trust. All of these things we could talk for hours about all this stuff. So we'll just kind of go through this quick. Holding company basics. The idea of a holding company is that you have an entity like an LLC that then holds your passive investments. Wyoming is a great state. And the reason that you see Wyoming up here, Wyoming, if you're going to have a holding company and you're going to do it as an LLC, Wyoming is a great state because Wyoming has charging order protection. And what a charging order protection says is if the LLC gets sued, the exclusive remedy of that creditor is that they get a charging order. And what is a charging order? A charging order says that as the creditor, I have the right to the distributions that LLC would make to its members, right, to its owners. But I don't get to control when those distributions are made. Okay, so I get sued, right? There's a judgment against me. I owe somebody $1 million, but I had a Wyoming LLC, and all they got was a charging order. So they have the right, anytime that me individually, anytime I'm going to take money out of my LLC, I have to give that money to them to pay off that $1 million that I owe them. But they don't get to decide when I take that money. Okay, so that's a good thing about charging order. So some plaintiffs' attorneys will look at that and say, when are we going to collect on this, right? I don't know, as the plaintiff's attorney that I'm going to represent you, I don't know whenever we're going to get a charging order, that's the best case scenario. I don't know when I'm going to be able to collect, right? This litigation is going to cost me a year's worth. It's a contingency fee type situation. So that charging order protection, that's one thing that's great about it. Wyoming. Arkansas has charging order protection as well. What's better about Wyoming is when I go into Arkansas and I set up an LLC, I have to put who are the members of that LLC, who owns this company. In Wyoming, it's anonymous. It's anonymous, right? So that's the other thing. Let's say you have a slip and fall. Hey, okay, this LLC, whatever, there's a trail of LLCs that own stuff, but then it gets to a Wyoming holding company. Who owns it? Well, I don't know that it's, Rich Doctor with a ton of real estate deals too. Like, I don't know who owns it. And then somebody might look at me too. If let's say I, get in a car wreck, I run somebody over, right? And they're going to sue me personally. Again, a plaintiff's attorney, they start looking at, okay, what assets? Car wreck's probably not great because you got insurance that you're going to go to the insurance company. But someone wants to sue me for whatever reason, right? But I hold all of my assets, everything that I own, right, is through a Wyoming LLC. Well, they can't figure out that I own that Wyoming LLC unless I publicize it somewhere or told people about it. So they look at Beau Fugitt, they go to Arkansas and they see, does he own any real estate? Does he own any? No, he doesn't own any real estate. Does he own anything? And it looks like I don't own anything. So it's a deterrent, right, to keep people from suing you. ultimately, at the end of the day, that's what I'm talking about.
One quick thing, I'm sorry, I know you're short. What I see a lot in Arkansas are quick claim deeds, you didn't see those, I mean, they've existed for a long time, but I see a lot of them. So if I'm rolling up an asset that I own now, either through one LLC or individual, and I want to put it in one of these, and so that I'm going to raise funds on later, and I roll that into that new entity by quick claim deed, does it really matter whether I go and issue a warranty deed?
The way you should do that,
Or they-
you should take.
In the context of asset protection.
Well, on the quitclaim deed should have the LLC's name, right? I mean, that's who should be on it. And you can take a quitclaim deed. The quitclaim deed does not have to be that I'm just giving it to some person that I'm related to or myself, right? I could go buy it.
No, I know that, yeah, that's what I'm asking.
Well, maybe I'm not following.
So if I would have a property, I'm going to transfer the ownership of that property.
Oh, right, yeah.
Into the LLC, which I may be interested,
Exactly.
right?
Yeah.
And there's Wyoming.
I bought a property in my personal name, and now I say, oh, shoot, it probably would have been better to have this in an LLC.
Yeah.
Yeah, absolutely. You could quitclaim deed this into an
So
LLC.
now you have an asset protection case, let's just say, and they start looking at it, well, he just 6 months ago owned this himself, now he rolled it up in this entity, looks like he was trying to.
It could, and you can always have depositions, right? And they could, if they want to go down that rabbit hole, they can. Do this,
But it's just a layer.
It's another way. None of it's bulletproof. None of it makes it bulletproof.
Yeah.
But I was in the Marines, right? And we had this concept of a defense in depth, right? And that means that you don't, and we're seeing it now with Russia, you guys follow that. But it means that I don't just have one thing that it's like, this is not my just defense. I've got this, then I've got this other shield, then I've got this other shield, then I've got this other shield, so that if they break through this one shield, I've got my other things right in place. And so that's what kind of all this stuff is. It's just all these, the more steps you can take, the more complicated you can make it, ideally, it'll help you.
And
You
because of the
have to be
commonality,
a Wyoming.
doesn't raise a red flag necessarily, it is so common here, everybody,
Yeah,
I always tell all my clients to put it in your trust or put it in your LLC.
I'm buying a lot.
Indeed.
I'm buying a lot in Bella Vista and I'm not spending much on it. I just want to have like a DOA membership, so I'm gonna quit playing it just because it's like, my family, so there's a lot of reasons.
But I thought I read somewhere that the federal government is having this new rule that as of January, all this goes away.
Well, there has been pushback, but the courts are gonna have to rule that. So the federal government doesn't just get to come in. But yeah.
Yeah.
Do you have to be Wyoming local to have a Wyoming LLC?
No. So, no, you can set up a Wyoming LLC anywhere. Now, if you're doing business in a state, if you own property in a state, then the LLC should be registered in that state. So if you're gonna buy a property in Arkansas, and if you're gonna use this Wyoming holding entity route, then is what the way that I would do this is, and I should give a caveat. Zero, I should have said this at the very beginning. I'm not giving anyone legal advice right now. So, simulators, malpractice, I'm gonna give you legal advice. No legal advice.
We do it this way.
Certainly. But so I would probably have your Wyoming holding company LLC that then is the member of an Arkansas LLC, and then you hold title to that property in your Arkansas LLC. So your tenant slips and falls, they go, all right, we're gonna sue this, who owns this property? This LLC. Who owns that LLC? This Wyoming LLC. Who owns that Wyoming LLC? We don't know.
Yeah.
Right? That's the theory at least. No operation, so a holding company, you're holding assets, you're not operating things, because as soon as you start operating, you start having liability, right? So if I'm a real estate agent, I'm not gonna, in my holding company, I'm not going to be representing clients via this entity, because then when I do something wrong, right, it's just to hold assets. Okay, corporate veil. This is how another way that all this can just crumble and all die is if you pierce the corporate veil. And the corporate veil essentially says that these entities that I'm creating, they are separate legal persons, right? Think of it as like literally it's a different person. Okay, that's the legal rule, the thing that is like, I just had a baby and it's a totally different person, right? But if I start acting like they're not separate people, then you're going to pierce the corporate veil, and all that limited liability protection that you had all goes away. And the court's just going to look at it and say, yeah, these were really just alter egos of the same person. They were not separate persons. And so you have all these LLCs put in place, but you pierce the corporate veil, so they get to sue you personally, and they get to come after all your personal stuff. So the most common ways that you're gonna pierce the corporate veil is commingling of funds, right? Every LLC you have should have its own bank account. Because whose money is it, right? If I'm paying for things and I don't have separate bank accounts for all my different LLCs, then I'm commingling funds, right? The other thing, inadequate capitalization, right? I set up all these LLCs and they all have $1,000 in their bank account, but it owns, $1 million of property or whatever the case is, and I'm engaging in all this business, and there's no way that I could actually pay my debts. And I keep this low all the time. The corporate look at that and say, yeah, you weren't actually treating this as a separate person. It's a facade. We're gonna pierce the corporate veil there. Fraud, misrepresentation. If I actually commit fraud, do something illegal, and of course, you don't get limited liability for that, right? You don't get limited liability for fraud. And then corporate formalities. I don't keep up on that corporate formalities. That is right. I don't keep meetings and minutes. I don't keep good books. I don't abide by what the operating agreement says that we have to do in order to make decisions. Then the court could look at that and pierce the corporate veil too. So all these things, I see people, they'll have this whole flow chart of their asset protection, and they'll have it set up, but then they're just they get so sloppy with their corporate formalities. It's like, man, if you get in trouble, they're going to pierce right through all this, and they're going to come after you. And it doesn't matter that you have 6 businesses, 6 LLCs set up. You've been paying the wages of this company via this company, and you've been paying the debts of this company with this bank account, and now you just pierced it all and you've ruined everything. So, asset protection trusts, these are getting more and more popular. Arkansas, we are, I think next month actually is when the statute actually comes into effect, but we're going to have an asset protection trust. And that the good thing about trusts are LLCs protect you. You got outside liability, inside liability, right? Inside liability would be like, I own a property in an LLC, my tenant in that property slips and falls, they can't come after me, they can't get all my personal assets because I have a limited liability company. That's what they're doing, it limits my liability. Well, problem is, what happens if I'm driving to work and I run over a kid on their bicycle? Well, now I can be sued personally, and I own that LLC. So now they can not only come after me, but they can come after all my assets. They can come after that LLC that I own, and they can come after everything. So you got that kind of bottom up or outside versus inside liability. What an asset protection trust does, literally you own nothing, right? I'm the beneficiary of the trust. The trust owns everything. So even if I run somebody over, you come after me personally. In theory, the asset protection trust, again, you have to abide by all the formalities. It has to be structured right. There's a much deeper conversation as to how you set that up. But that trust can help you protect your assets. Best advice I can give you is don't run people over. So this is a total just like a hypothetical, right? But this is something that can happen, right? If my asset protection trust could then own my holding company LLC, and then my holding company LLC could own my real estate. I've got multiple properties in that real estate, right? They could also, my holding company, I'm going to be a passive investor in syndications, right? I'm going to passively invest via my holding company, right? I'm not going to invest myself personally, but I'm going to put my holding company to do it. And then I could have other operations. And then also with this holding company, you could branch out again, branch out again, branch out again. You could have multiple holding companies. Again, defense in depth. The more complicated you make it, in theory, the more defense there is. However, the more complicated you make it, formalities for all these things. So you just got to stay on top of it, right? And there's not a one size fits all. A lot of it is just going to depend on what is your actual risk of being, sued. What's your tolerance for risk? How good are you with administrative things, right? It's not a one size fits all. And full caveat, they're estate planning attorneys. That's like what they do. And I'm not an estate planning attorney, but I just see this enough that. Okay, so now we'll talk about some passive investor considerations, right? So I think I may have even stole this from Brian, you said something very similar to this, right? In one of your posts, I think, but as an LP, what am I looking at? Okay, the sponsor or the GP, the location or the market, right? And then the asset. So what do I mean by that? Is first off, is it Warren Buffett or is it Grant Cardone or is it some guy I just met on the bridge, right? Who's the person that I'm actually giving my money to? That's going to be a very important thing. Is do I actually trust this person? Are they the type of person that I want to give my money to? Because they're going to have a fiduciary to me. That's going to be a really important consideration. The second thing would be like the location or the market, right? Hey, it's Warren Buffett, but he's saying he wants to go buy properties in Detroit. You know, it's like, I don't know if I like Detroit because that's a dying city, I think. So maybe I don't want to go there. Also the market, right? If it's, 2008 and the bubble has just burst, do I even want to be putting my money in real estate? I don't know right now. Maybe I'll wait a year or so, right? The market's going to be important too. And then the asset itself. If it's a fund, do I trust this person? Do I like the property, right? So those things are going to be important. The other things, and I should say this too, it amazes me sometimes, people will invest passively in a deal and they'll put $100,000 into a deal and I think most of them do not have a lawyer review the deal for them. And I know if it's me, and I don't do this every day, if I'm going to put $100,000 into a deal, it might be a good idea to spend the extra $2,000, $1 to $2,000 to have an attorney review everything to help cover you. And I know that's like asking the barber if you need a haircut, right? That's like my favorite. The barber's always going to tell you that you need a haircut. The lawyer's going to tell you to go hire an attorney. But I think it's a pretty good sell, right? You're about to invest a bunch of money. Maybe it's worth it to hire a lawyer. So the next thing that I'm going to look at is the fees, right? What type of fees is the sponsor taking? Sometimes I see people get audacious with the fees that they're going to take, right? There's a development fee and there's a 6% transaction fee and there's a 5% asset management fee and and they start stacking up these fees. So they tell you that, hey, our investors get 80% of the deal. You get 80% of the cash flow after all the fees. And that sounds like, wow, that's pretty good. But then you start looking at all the fees and it's like, dude, you're going to kill it on the fees. There's not going to be any money left after you pay all these fees. So that's the thing that I would look at. The underwriting and the projections. This was really going to come down to who's doing your deal. I see all sorts of people do it. I'll see people that they have very conservative projections and they may even have like worst case, best case, and then there are some people that it's like they're still underwriting deals like it's 2021, and I'm looking at them going, because I see a lot of these things and I think that is a very aggressive projection, right? And so looking at their underwriting, asking questions too, right? If you're looking at investing in a deal, ask them about their underwriting questions, ask them about their assumptions. If you have questions, don't just take their word for it. Remember, they want your money, okay? So ask them questions, ask them about their underwriting. And if they don't have good answers, then that could be a red flag. 1031 typically does not work in these traditional syndications, right? So 1031 funds, that is a like kind exchange. It means that I'm selling real estate to then go buy real estate. As an LP, if I'm a passive investor and I sell real estate, well, now I'm going and buying shares of a company, right? It's like selling real estate to go buy stock. It's not a like kind exchange. So in order to be a 1031 member, you have to be a tenant in common. And that means you have the syndication LLC that's going to own it and me, right? I'm going to be on the title with them. That way I'm actually owning real estate, not just interest in an entity. So you can still do it, right? If you want to go raise money if you want to go do this, you can still take 1031 funds. Just understand that you're going to have to structure the deal a little bit differently. And they may have more say because they need to have substantial duties, right? Yeah, right? Because now it's not a security, it's more like a joint venture. So they may need to be more involved in the deal. They could say, let's sell. I want to sell, right? And you can say, oh, crap. I didn't really want to sell right now. And you can put together tech agreements. You definitely have a lawyer help you do that, but you can set this up. Okay, the PPM, the private placement memorandum, that is going to be in a lot of these syndication deals, there's gonna be a requirement to have a private placement memorandum. And what that is all the disclosures. It's not a contract. The PPM is not a contract. You do not have to sign it as a passive investor. It is simply a disclosure document. It's typically about 30 to 40 pages for a real estate agent. And it's all the ways you can lose your money. I like to say that the pitch deck, right? That's gonna be like the slideshow that they prepare to give you, to like tell you about the deal. The pitch deck is all the reasons why you want to invest your money. The PPM is all the reasons you don't. So it's just two sides of the coin. But you want to look at the PPM and you want to compare it to the operating agreement, because the operating agreement controls. If the PPM says you're going to get 80% distributions and the operating agreement says you're going to get 70, the operating agreement controls. Now you would have a case to say they committed fraud because they told me that I was going to make 80%, and really the operating agreement says I'm going to make 70. But look at the operating agreement, compare them. It's going to be important. When you're looking at the operating agreement, look at the capital call provisions, right? If you think you're investing $50,000, but then you see that the manager has the right for capital calls, then okay, you may have to pony up later, or you may be diluted on your shares. So look at that too, and understand that. Ask them about that. What are the capital call provisions? Understand that. Understand this is not like stock. Even though it's regulated by the SEC, I can't just sell this stuff. It's not liquid. For these exemptions, one of the restrictions on it is that these are not transferable within the first 12 months. So you got to hold it for 12 months. There's some caveats to that, like if I buy it in my personal name and then I decide, oh shoot, I should have put this in an LLC, I can do that, but it still has to be under the same control. Okay, so there's some limited exceptions, but don't think that, hey, I'll just do this deal and then if things, if I start not liking the deal or if I need to like get my cash out or something, I'll just go sell it. It's not that easy. Understand the lending situation, right? So they come to you, I'll see a lot of pitch decks that do not talk about the lending at all, right? And I want to understand, okay, is this a fixed interest rate? Is it, is this a bridge loan? Are we gonna have to refinance in a certain number of years? That's where you start to see a lot of these deals go south, is they'll want to do some type of value add. They'll take on short-term debt, and you did it in 2021, and you have to refinance in 3 years, and that 3% that you got in 2021, our bridge loan is running out in 2023, 2024. Rates have changed significantly. I'm going to have to go take out a loan at a much higher interest rate. And are we still going to be able to service the debt, right? Are we still going to be able to pay the loan? So just understand it, right? Understand the loans, ask questions. How are we financing this other than you taking my $50,000, right? What else are we doing? Expectation of communication, right? Ask them how often you communicate with me. What if I want to see the books? Are you going to let me do that? Have those conversations at the outset. Understand that you don't have a right to manage. And if you start all of a sudden, I don't like the way that they're doing this. Hey, I don't like how you're doing this. I want you to don't buy, don't put new paint. I want you to get the new roof, right? You don't have any right to manage. That's part of the security. If I buy Apple stock, I don't get to go call the CEO of Apple and be like, hey, this new iPhone is garbage. I want you to fix it. They don't care. And it's the same thing when you're doing this. There's no right to manage. And then past performance. If they're showing you deals that they've done in the past, ask them, are these all the deals you've done in the past? It is illegal to cherry pick. What I mean by that is you can't just, if I'm going out and raising money, I can't just pick my best deals and tell you about those deals. I'm supposed to tell you about all the deals. But if someone's showing you like, hey, see, you made a ton of money on this deal, and we made a ton of money on that deal, ask them, have you done any other deals that are not here? And if they get shady, they're like, well, yeah, we have filed for bankruptcy on one, we foreclosed on another, right? Understand that too, and ask those questions. These are the legal documents, the standard legal documents that you would see in one of these transactions. So you got the private placement memorandum, we talked about that, right? That's going to be a lot of your risk disclosures. You got the operating agreement, the partnership agreement, could be the bylaws if it's a corporation. But that's going to talk about how the company is managed and what are the rules of the company. The subscription agreement, or it could be a note if it's structured as debt, right? But the subscription agreement, I think, is essentially your purchase agreement for stock, for your membership shares in the LLC, the purchase agreement. The investor questionnaire, typically the sponsor is going to ask you questions about, are you accredited, right? All these certain things, you're going to see that. And then you're going to see the pitch deck, right? And I throw the pitch deck in, it's not necessarily a legal document per se. To the SEC it is. Because if someone gets audited, the SEC is going to look at that pitch deck, and they're actually going to look at all the communications that you had with your investors. And if the pitch deck said that I was going to get an 80% return, and then I haven't been getting that, or 80% of the distributions, and really they've only been giving me 50% or whatever the case is, that's just one example. Then the SEC is going to look at that and they're going to say, oh, you committed fraud right here. Or they said projections, right? Timeline, 10 years. And they didn't say projected timeline or something, right? Especially if I'm selling to non-accredited investors. 10 years pops up and they don't sell. I say, hey, you told me on your pitch deck we were selling it 10 years, right? So those are just, and that's the type of thing I'm always advising people, like whenever I'm going through and looking at pitch decks, I'm saying, targeted returns here, projected timelines here, right? I'm doing all the legal, like CYA stuff. Anyways, that's the spiel. I could keep talking for hours, so thank you guys.
And you have a local office here.
So yeah, our firm is totally virtual. We had an office up until COVID, and then we realized that
Gotcha.
we didn't need one.
Yeah.
So no, it's
But you're local.
I'm local. I live in Bella Vista.
Okay.
Yeah. Cool. So yeah, I appreciate it. Okay, if you guys have any questions at any time, please reach out to me. You're not going to get a bill for a phone call. Give me a call, we'll talk through stuff. Yeah.
Well, maybe any one or two questions. If you guys, anyone needs to leave, I know some people will have kids waiting, so feel free to but any one or two questions from the crowd? I'll ask one about the voting. I've seen where members get no voting rights, or members get voting rights if there's bad character in the managers. How often do you see members have voting rights, and typically to what extent?
Yeah, so that's going to be in the operating agreement. That's where you're going to find the partnership agreement, whatever the case is. In the deals that we put together, unless there's a specific reason to do otherwise, we're going to give the passive investors very limited voting rights. And that's because we also want to keep them as passive investors, right? If you start to give them too many rights, now they're not necessarily passive investors. But typically, the voting rights that we're going to give them is to essentially fire the managers from misconduct, to appoint new managers if, let's say, God forbid, he dies, right? They pass away, whatever the case is, right? Appointing new managers. And also, we will typically throw in a provision if the manager wants to take a loan from the syndication entity itself, we'll give the members the right to approve that or not. Right? That way the manager can't just come in and say, oh shoot, like I got my personal issues, whatever, so I'm gonna take a loan from the business.
Yeah. It's important to list that because sometimes passive investors feel very like, oh, I have nothing I can do if something goes wrong, but like if there's factors, etc., you can pull them out and take on additional action.
Yeah, so yeah, that would be one of the important things to look in the operating agreement. Yeah.
Cool. Yeah. Awesome. Well, feel free to reach out to Beau. That's his contact. As a way to wrap up, I know there's a check-in form in there passed around. You'll get notification from the future events on there. We also have a Facebook group, Northwest Arkansas Commercial Real Estate as well. For events like this time, we're very thankful that Keller Williams, I forgot to mention, they let us use their location. Our next time will be in a different location called Banders, and we have dinner last time as well. We'll talk a little bit about the next events.
Okay.
And we need to let you guys know. Not using Apple here. How do I
Eric. Yeah, you have the right one. Yeah, I think so. That would be great. You're like right on it.
Okay, I think that.
And if yours are right.
Yeah, I think they're good. So that's what we had today about partnership, deal structures, and best practices. And Brian, feel free to come up if you want to do up next time. One will be August 15th on the Tuesday as well. We'll have a few brokers. Recently we just also did Fugitt Valley. He will also be representing on the panel as well, we'll meet at him, but we'll be talking about what's happening with the commercial real estate market. For the broker roundtable, some of them, all of them are actually local and, you know, the market has been changing a lot with interest rate rising and kind of stabilizing, and the Northwest Arkansas market is being different as well. We wanna kind of get a point of view from those brokers. Do you have anything to add, Brian?
Brian's with MMG and then Zach's with GREA, but,
Right.
yeah, I think, we'll have a great panel. These guys are all very active in multifamily scene and multifamily, commercial, retail, office. It's kind of interesting perspective from each one of these. We did this in December of last year, and it was really good to see kind of, you know, obviously no one has a crystal ball, but you know, these guys are boots on the ground and seeing what's happening in commercial real estate. So great one to come and network with some active guys in the market.
Yes, and then the one after that in September, we don't have the location yet, but we'll actually have Brian's partner, George Brew, from Elevate. He'll be traveling from Dallas to come talk about construction management and multifamily commercial real estate. He has a heavy construction background, and so I'm excited to hear and learn from him as well.
Yeah, I think it'll be great on the construction side of, you know, that can really make or break deals. And, you know, George has J&T Construction where we're actually looking at expanding to Northwest Arkansas with the some of the stuff we're doing watercolors. So that's a really great topic. You know, when you're getting into value add projects, development projects, you know, any sort of commercial real estate, that construction side can really make or break your deal. So I think it'll be a great topic as well.
Yeah. And yeah, so stay engaged on the Facebook group if you're not in there. And for our next two events, if you know anyone that's interested in sponsoring, feel free to talk to me or Brian. David sponsored our events in the past. I believe he has got some good leads from being a sponsor. So let us know. Is there anything else you want to add before we end the conversation?
Yeah, the sponsor, I mean, it goes on both of our social media, elevates, you know, that we have about 10,000 on our email list and on our social media pages. So a lot of good traction on the social media. So we definitely appreciate the sponsor partnerships and appreciate all you guys for being here. So
Cool. Feel free to network as we wrap up
Thank you.
here. Thank you so much.